Hello, and welcome to Ipsy Dixit. I'm your host, Ben Edwards, Associate Professor of Law at the University of Nevada, Las Vegas, William S. Boyd School of Law. I'm here with Gregory H. Shill, Associate Professor of Law at the University of Iowa. We'll be talking about his new essay, Congressional Insider Trading. Welcome back to the podcast.
Thanks, Ben. It's a pleasure to be with you.
So glad to have you. This is I wanted to get back into podcasting just because of this paper and because I think it's such an important issue right now, and it's been highlighted by a lot of developments in the news. So let's start by talking about the current event hook around this perennial issue of how to deal with congressional securities trading. So what's happened recently?
Yeah. So as you know, the topic of insider trading by members of Congress is evergreen, but is back in the news because of some trades executed. There were several, but in particular ones by Senator Richard Burr of North Carolina and Kelly Loeffler of Georgia, following a confidential White House briefing of senators on January 24th.
So let's take them separately. So Richard Burr, senator from North Carolina, what does he do? What kind of trades does he make?
Yeah, so he does a few things. So the briefing is on January 24th, and I'm not going to try to offer here a comprehensive history of the facts, partly because we don't know all of them yet, and so we're bound to get preempted by events. But basic posture is he gets the information. Then within about 2 weeks, he writes an op-ed for Fox News website where he says the pandemic is going to be okay in the U.S. President Trump's leadership is going to lead us forward. We're in a very good position. Don't overreact. And the gist of the briefing on January 24th that he had received was the opposite, was that this is going to be devastating in the United States. And then our third sort of point in the timeline is about a week after he writes that op-ed, he does a bunch of trades, including most controversially selling stock in hotel companies,
right.
Which
probably a lot of travel.
Yeah, I mean, the more you know about the pandemic, the more you know that travel will be kind of disproportionately impacted. And in fact, he saved himself a bunch of money by cashing in that stock. Additionally, he at some point after that goes to a group of supporters who come to Washington. They meet at the Capitol Hill Club, which is a private club near Congress. And in this private setting, he says, basically, people should be taking this more seriously. This is dangerous. The situation is dire, and so forth. So he's taken some inconsistent actions here, and he makes this what a securities lawyer would call a selective disclosure to a group of supporters after liquidating his stocks, which was after reassuring the public that everything was okay. And those things, as well as the briefing where he got the information, all happened in pretty close succession. So there's at least some kind of circumstantial case that he traded on material non-public information available to him by virtue of his job.
Interesting. So I can see why a lot of people are upset and why there's going to be a lot of investigation into what happened around these trades. So without spending too much time on the details and nuances of his trades, there's another senator from Georgia, the same party, who also traded. It was Senator Loeffler. How did her trades go down? So she was in the same briefing, got the news. Mm-hmm. What did she do?
Yeah, so Senator Loeffler is married to the chairman and CEO of the New York Stock Exchange, who is a very wealthy person. He's worth at least $500 million.
Right.
And on the same day as the briefing, trades were executed on her behalf, so there's again the sort of circumstantial connection. Now, there is a wrinkle here, which is that she claims that her portfolio is managed on a blind basis by a third party, and that she does not play a role in strategy. Um, Presumably, she sets a sort of high level strategy, but she doesn't tell them, buy,
Yeah.
sell, or
But
buy
the
this, sell
discretionary
that.
account is managed by
Right,
the board.
right. So,
I think Martha
that
Stewart
can't.
tried that defense.
Martha Stewart had something similar.
Yeah, Martha Stewart tried that defense.
Yeah,
Broker made the decisions, not me, but it ended up not holding up with an
yeah.
obstruction
So
charge.
D- Donna Nagy had who's a professor, colleague of ours at Indiana University, had an op-ed in the Washington Post, and she's somebody who's been writing about congressional insider trading for a long time, and she's the view that she took was that we need to know more about the arrangements of that alleged blind trust. It has to satisfy certain requirements in order for it to protect her from exposure. So so there's all kinds of factual wrinkles here that will have to be developed. But I thought it was a good on ramp to talk about a bigger subject.
This is a perennial issue, and securities trading by better informed insiders is a problem that we have to deal with if we want our securities markets to work well. I know you talk about what we do, in the general corporate context. So if you're a CEO at a public company, and you're in that context, if the CEO has shares and the CEO wants to sell shares, how does that happen?
Yeah. So the basic situation, which is common to both public companies and members of Congress, and for that matter, members of the executive branch and the judiciary, is that people in these positions have material non-public information. So the law clerk who's up all night drafting an opinion, striking
No.
down a healthcare, bill, or invalidating a patent or what have you, um, they have MNPI, as securities lawyers call it, and um, the same is true for members of Congress and of course in the White House. And it's also true at the executive level, right? So you could imagine Jeff Bezos, CEO of Amazon, getting briefings about what's going on in China, about the supply chain and their ability to satisfy certain orders and what demand for Purell looks like. I mean, they're getting information that allows them to put together a picture. At the same time, they're human beings and they have economic uh, interests and needs. It may sound silly to talk about the richest man in the world as having economic needs, but if you could very easily generalize from the CEO of the biggest company to just people who work for companies and have an NPI about them, or staffers on Capitol Hill, or again that law clerk or what have you, and people have a need to buy and sell stock, perhaps to make a tuition payment or make a down payment on a new house or what have you. And
Right.
so, in recognition of that, the securities regulation regime has, evolved certain tools to deal with the simultaneous fact of people who are in possession of MNPI and those same people needing, for economic reasons, to trade. And so that doesn't present an irresolvable problem. It just suggests the need for a system,
Right.
and that's what I think we can learn from the SecReg world.
So how does this system work if you're gonna want to buy a house in about 8 months, and so you want to get your down payment ready, you want to pull money out of the market. How do you put that ball into motion as a corporate insider?
Well, there's basically there are a lot of rules that bear on this, but the two that I talk about are what's called a 10b5-1 plan and the Section 16b short swing profits rule that comes from the Exchange Act of 1934. So let's start with the 10b5-1 plan. This is a plan that an executive or a director would adopt ex ante. So in fact, they have to adopt it at a time when they're not in possession of MNPI, for example, before they join the company or immediately after the disclosure of a 10K or an earnings release. Um, and the 10b5-1 plan is just, it just says, like, I will buy, let's say, 100 shares of stock the 15th of the month, every month, until this plan is canceled, something like that. And it's a commitment device. It's a way of providing a measure of transparency. And I want to come back to that because it's not intrinsically transparent. A measure of transparency and a measure of certainty and so forth. And now that said, if the executive wants to buy the house, and most executives are not Jeff Bezos, even public company executives, may have needs that require them to liquidate their shares or some of their shares, and so they know that 8 months from now they're going to need some money, so they might suspend or modify their 10b5-1 plan, and they would do so upon the advice of counsel, so that when they do so, they don't endanger this safe harbor. That's what a 10b5-1 plan is. It is not an absolute defense to an insider trading charge, but it is an affirmative defense. And if a plan is adopted and followed consistently, then it can be a successful defense. And so they would suspend or modify it in a way that doesn't trigger problems. Like they wouldn't do it frequently. They wouldn't. They wouldn't. And there would be usually a waiting period before the change would go into effect. So it's hard to game. And so they would do that. So they manage their cash flow and have the money. The reason I say a measure of transparency is that corporate 10b5-1 plans are not public. They can be divulged in litigation or other proceedings. Maybe an investor can get one through a 220 request. That's Section 220 of the Delaware General Corporation Law. But it would have to be pretty closely related to some corporate action. You couldn't just request all the 10b5-1 plans of all the executives and directors. So these things are not like published on the company website. Now, that's one difference that I propose here. I don't think we should translate this regime verbatim. I think we should use it by analogy. And so Congress should make congressional 10b5-1 plans public information. So that's one piece of it. And then there's the 16B thing. Yeah.
Right.
Yeah. So this is basically an ex post. So the 10b5-1 plan is ex ante in its disclosure.
Right.
16B is ex post, and it's focused on disgorgement. So this is a very simple rule. I mean, these both have the advantage of being bright line rules. If any two trades within a 6-month window can be identified that create a profit, then the profit can be disgorged to the corporation. So if the CEO buys $100,000 of stock on January 2nd and sells that stock on May 2nd, and that trade generates a profit, then that profit can be disgorged. And the reason for that, again, is that this is a system that assumes that insiders have an MPI and need to trade. And so if they're trading to generate a profit, then they're presumed to have timed that trade to generate a profit based on inside information. This doesn't result in criminal liability or any kind of enforcement action. It can, but then that requires showing scienter.
Okay.
But
so you've got these rules for regulating securities trading, just for people who need to trade in public companies. Now, there are rules of the road there. They can be gamed in some ways. I can imagine executives manipulating the disclosure of information once they have their plan set so that it's always high when they're selling and low when they're buying. I could see all that stuff happening, but it's certainly better than no system at all. What does Congress have? How do we regulate that right now? Do they have something like these plans?
They have a rudimentary disclosure system, and I would just briefly, I'm not here to, despite my name, to shill for the existing system, but I think it actually is quite hard to game. There are other aspects of securities regulation where opportunism is easier, but I think the problem with 10b5-1 plans, for example, is not so much that they are easy to game; it's that they can be kept confidential. In other words, it's hard to actually game the plan.
Right.
But yeah, so the current system is really twofold in Congress. So one is the background system of securities, fraud, enforcement, and litigation. Um, and that's your 10b5, and associated insider trading prohibitions and criminal and civil penalties that are administered by DOJ and the SEC. And that's where most of the energy in this discussion has gone. It's very litigation oriented. That is the frame, should Burr be locked up, that kind of thing.
Right.
And the problem with that is that where the trader can plausibly claim to have been motivated by public as well as
Private
inside
information.
information, then there's a circuit split on whether they can be held liable for the trade.
And information about the pandemic was widely available.
Right, and it's not like the pandemic was a secret, and the fact that it moved maybe from the inside of the newspaper to the front page between the briefing and the trade, like, doesn't really, it's very, that's not the standard. There was well regarded public information available at least in January, that it was going to be quite serious. And so Senator Burr could, and in fact has, claimed that he based his trade fully on public information and that the
Right.
briefing he received was not even a factor at all. So, that's where the litigation framework falls short. As I mentioned, there's facts we don't know, and we'll see what happens. But there's just an inherent problem there, because people in his position will always be able to claim mixed motives, and that claim will be plausible most of the time.
Hmm.
So the system is, that's the first piece of the status quo. Mm-hmm.
Enforcement seems like it's just going to be a real challenge to deal with, and if you keep having these kinds of situations crop up, it's going to reduce overall confidence in either the market being fair or whether public officials are uh, motivated by the public good or by their private ability to game the stock market. So what should we do? Like how would we regulate this from if we know this problem exists, we know this problem can recur. Putting to the side the defenses that Burr may raise in litigation he's probably going to face. How would you regulate this for Congress?
So I would start with the other piece of the status quo, which I would modify pretty significantly, and that is the internal disclosure mechanisms that each House of Congress has adopted for itself, pursuant to the Stock Act, which is a 2012 law that expressly extends federal insider trading prohibitions to members of Congress and the other two branches. So right now, that disclosure system that they have is ex post only. So there's no parallel to the Rule 10b5-1 plan model.
Right.
So I would adopt an ex ante model as well. But even the ex post disclosure that's required consists of two sets of disclosures. One are periodic. They're periodic transaction reports that have to be filed after a trade, and the other is an annual financial disclosure. The periodic reports can be filed up to 45 days after the trade, which is just an astounding amount of time if the goal is to add some sunlight to the member of Congress's conduct during a window when it might have been based on MNPI. I mean,
Right.
no MNPI just about will last 45 days. And so, just by contrast, the analog in the corporate world, which is the requirement to file a beneficial ownership report on Form 3, 4, or 5. Here, the parallel will be Form 4. That window is 2 business days. So, like if a CEO, Tim Cook, for example, sold a bunch of Apple stock last year, filed a Form 4. He had 2 days to do that. And in that report, it was reported that that trades were executed pursuant to a 10b5-1 plan. That is exactly the kind of thing I'm envisioning here, is that there would be a very short window, and there would be a pre-existing 10b5-1 plan in place that would dictate the trade.
That makes sense to me. Would you also bring over the short swing profit prohibition?
Yeah, so I would. There, the purpose of the short swing profits rule is to capture some of the possibility for profits based on MNPI, notwithstanding rules like 10b5-1. So it's like a belt and suspenders, and it's 10b5-1 is preventative, and it kind of regularizes and proceduralizes the trades, and if public would provide transparency, but things are going to creep through, and if a member of Congress turns a profit on a trade within a 6-month window, then it's my view that, just as would be the case for CEO, that trade is deemed based on MNPI. Doesn't mean the person goes to prison, let alone face any kind of
Right.
civil penalties, but just the profits are disgorged at the end. Yeah.
So that would take care of it. So you also call for ownership restrictions in terms of limiting what members of Congress can own. This strikes me as a really interesting proposal, and it's very different than what we see in the corporate context. What are you calling for?
Yeah, so there have been proposals on the table for a few years. Elizabeth Warren put one in her campaign platform. She borrowed it, or at least there was a similar one already on the floor from a few senators, that would bar ownership of individual stocks by members of Congress.
Right.
One of those proposals additionally bars service on any corporate boards, public company boards. Those both sound like good policies to me, but I think we should be realistic about their limitations. So let's say that the senators get this MNPI in a January 24th briefing, right? It would be very wise to dump hotel stock because travel is going to be decimated, right? But it would also be wise to dump any stock because the market is going to be decimated. And in fact, that's what happened. Yeah. So if you own an S&P 500 index fund, and because that's the only equity product you're allowed to own under the leading reform proposals, you can still make, or in this case, save a ton of money by trading on that information. And you can always claim that you're motivated really by public information. And so I don't think ownership restrictions alone are enough, but I think that they will be helpful, and they reduce the risk of, we've been sort of talking around what are the risks here. And I think, one of them is clearly self-enrichment, but another one is policy distortion. We don't want members of Congress tilting policy in favor of or against certain companies, which they have the power and incentive to do if they're allowed to own individual stocks. So there are a bunch of reasons why I think ownership restrictions are valuable.
Right.
But yeah.
No, I could see a situation where if someone owns, if their portfolio is comprised of let's say a large amount of pharmaceutical stocks, that they would, they might oppose moves to bring down prescription drug prices because it would hurt the shareholder returns for those companies. And you probably don't want members of Congress having that incentive pulling them in a different direction. But why not just let voters decide? If we're disclosing all of this and we're disclosing the trades, why don't we just allow ordinary voters to decide whether or not they're okay with particular trades and vote them out if they don't like them?
Well, I worry that kind of argument is a little bit of a turtles all the way down situation where we end up with really no basis for regulating the conduct of public officials other than the ballot box. And I don't think we really believe that. I mean, for example, nobody would suggest that it should be legal to bribe members of Congress because if the bribes come out, then the member of Congress will suffer electoral consequences. This isn't quite that, but it's adjacent. And so, we already have enough problems with regulation of election funding and other issues. Um, this, I don't think there is a lot of public support for. I know there's some kind of contrarian scholars who want to like fully legalize insider trading, but I don't think there's a lot of public support. Interestingly, Henry Manny, who famously is, he's a now deceased scholar, but he made his name arguing for the legalization of insider trading on the theory that it would enhance price discovery and efficiency of markets. Even he was uh, opposed to allowing members of Congress to engage in insider trading.
Oh, wow.
Um,
No, huge
the
problem.
theory was that they would purely be engaging in profiteering, and there was no kind of capital markets advantage to permitting that behavior. So I guess I don't see a strong normative case, but I also think from a kind of efficient markets perspective, it's difficult to see why that ought to be allowed.
I generally share your view on this. My feeling is that the United States does well in part because we have large and robust capital markets, and much of the world sends capital here to invest. And it's hard to know exactly which straw is the one that's going to break the camel's back. But the more you have a perception that the system is being gamed, or that it's unfair, or that U.S. politicians are taking advantage of it, then it sort of eats away at public confidence in the market, and it may also eat away, and probably does also eat away at public confidence in government, which can be really important for holding things together in a pandemic. So if you're thinking about this issue, how would we get a plan like this in place? What's left to do? What needs to happen?
Well, that to me is a virtue of the proposal that I've come up with, because I'm not calling for any new regulation or legislation, which in this political environment seems optimistic to expect. So, both of the pieces that all three of the pieces we've talked about, the Rule 10b5-1 ex ante regulation, the Section 16b sort of analogy on the ex post side, plus the ownership restrictions, those can each be adopted by each House as a matter of chamber rule, presumably through their ethics committee, at least in the first instance, and then by the full House or Senate. So those can be adopted essentially overnight. The other, because if there is disclosure as a result of that, then additional action, enforcement, or other litigation, whatever, can occur on the basis of those disclosures. That's in fact what happened in the Equifax breach, for example. An executive filed a Form 4, as they were obligated to do, and then that among other things triggered the investigation. And then that investigation uncovered insider trading, including by executives who were senior but not senior enough to have to file a Form 4. And like one of those guys was charged ultimately by DOJ and the SEC. So, I think that this system could generate additional action, but in the first instance, it would not require any legislation or regulation. It could be done, pretty much overnight by each House. There is something that this leaves unaddressed, though, which I think it's important to acknowledge, and that is the risk that conduct like what Senator Burr did when he made a selective disclosure to political supporters.
Right, the tips.
Yeah, the tips. So, right. So if we were talking about this, like if I were teaching my students about tipping in the context of insider trading, that's what this would be. This would be a tip. But this really does start to impinge on other considerations where the analogy between securities regulation and public policy breaks down. So, Senator Burr gave this information to his supporters, but you could envision a scenario where he calls up the head of the UNC hospital system and says, "You guys need to buy more masks. You need to buy more ventilators." Now that is a selective disclosure, and maybe the CEO of the hospital, places those orders, and then also like goes and buys stock in companies like 3M that make these maths. I mean, you could construct an exam hypothetical pretty easily, but is that really the kind of disclosure, at least by the senator, that we want to restrict? There are real public policy and even maybe free speech considerations there, and representation issues, constituent service,
Right.
and so forth. So, what I propose doesn't touch on that at
Right.
all.
The, the the personal benefit side, of this, if you look at the regular tipper tippy liability cases, if you're giving selective disclosures to hedge fund managers about what you're going to do the next day, in order to gin up, donations, that's that seems like an enforcement case. If you're warning constituents about things they need to know about, that strikes me as very different.
Yeah, I agree. Now there is an SEC rule that is intended to deal with that. It's called Regulation FD, or Regulation Fair Disclosure, and that might I flagged this in the essay, but I don't really develop it because adopting it, unlike the other pieces, would require legislation and regulation, in my judgment, and also it, as I mentioned, kind of implicates a bunch of extraneous issues that are beyond the scope of the essay. But I think that might be of some help.
Okay. Well, is there anything you'd like to leave our listeners with as they think about this issue going forward?
I think it's important to think about what the thing is that concerns us about congressional securities trading. And in my view, there are three things. One is policy distortion, as we talked about, the possibility that the member of Congress will tilt policy towards, in a certain way based on their power and their portfolio. Another is self-enrichment by the member of Congress, and that's closer to a traditional insider trading case. And then the third is enrichment of third parties, and that's like tipping, basically. That's what Senator Burr is accused of doing. And these things are related but distinct, and especially the third, I think, is different from the first two.
Right.
So that's my first thing, is to think kind of rigorously about the different risks and what they have in common, what they have not in common with their securities system. And then the second piece is to think about this from a regulatory perspective as opposed to a litigation or criminal law perspective. And the basic reality is, unless you want to ban ownership of securities by members of Congress, in which case I think you would see the makeup of Congress change, because people could not afford to save for retirement and be a member of Congress, for example, because they couldn't own stocks or bonds. So unless you want to go to that extreme, which I don't, as far as I'm aware, nobody's proposed, then trading by members of Congress is going to be inevitable. And members of Congress also inevitably have, and in fact create, material non-public information. So then the question is, how do we manage that? And that's where the models, I think, from the public company world are helpful.
Excellent. Well, thank you so much for coming on the podcast.
Absolutely. Thanks for having me, Ben. It's great to talk to you.
Hello, Mike. How you feeling?
My feeling is beyond necessity.
Is that a factory? Now, Mike, I got a question I would like to experiment on you.
Well, if I ask you an answer, what is the question?
Don't you know it's always polite to wait until you are asked before you say something?
I accept your exalipine. And besides, I will admit in it that you are a better language than I am. You got a right to be because you live next door to a school. And when I don't speak it such a fine, I am more than satisfied that you should make it a correction day.
Make it a what?
No, not a what. I say when I don't speak it good, I am satisfied that you should make me a correction day. A correction day. A correction day.
Take your time. Don't work so hard. Now, what do you want to say?
By golly, do you understand English?
Yes, do you speak it?
Well, what do you think I'm speaking, Spinach?
Well, then say something.
I say when I don't speak it good, I am satisfied to have you make it a correction day.
Mike, it would be a pleasure to me if you were deaf and dumb. I never hear such motions with a mouth in my life.
Looks to me like there's going to be a fight. I know you are a friend of mine, and whatever you speak for my own good.
All the harm I wish you for your own good.
I know that, but what did you done with the $2,000 I give you?
I told you I investigated your money in the stockings exchange.
In the what exchange?
The stockings exchange, the stock.
I don't know yet what you done with the $2,000 I give you. What did you done with it?
By golly, have I always got to be a kindergarten for you? I told you I investigated your money in the stockings exchange. The stock.
Well, what is that? Stock.
That word stock means something. And whatever it means, you're in with it.
I am satisfied so long as I am in with it. But what am I investigated in?
Your money is investigated in the Metropolitan Railroad. Every car what is running in New York today, you own shares of. You own part of them. You're interested in them.
What you speaking about? I got to pay my own fare.
Sure. But look, when we were standing on the corner this morning, and you whistled, didn't the car stop?
Yes?
Well, it don't do that for everybody.
What you talking about? What's that got to do with me?
And then again, when it was inside of the car, and the car didn't go to the street you wanted it to go, didn't the conductor give you a transfer? A changer?
A changer?
A transfer.
Oh, yeah, sure, I got it.
Well, that told you the stockholder.
Shut up. That shows nothing of the kind. Everybody else got a transfer.
Well, then they're all stockholders.
Well, what you told me to keep them and to save them up.
Sure, save up the transfers till you get 1,000 of them.
You bet your life I did, and it cost me many nickels to save them up.
But when you get 1,000, then you're going to get promoted.
Promoted to what? Do I get promoted?
Don't you understand? When you get 1,000 transfers, then you can stand on the corner yourself and get them out.
I don't like that. That's no good for me.
Nothing is any good for you. Look at the honor you lose.
But I don't want that honor. The only thing that I ever investigated my money in that didn't go up was an airship.